we start with today's incredible turnaround. After a weekend of escalating threats between the U.S. and Iran and a global sell-off overnight that saw markets from Asia to Europe drop, U.S. stocks proved surprisingly resilient, with all three major indexes finishing the day in the green. So, faced with one of the most significant escalations in Mideast conflict that we've seen in years, investors are holding strong. So can anything shake this market? What do you make of the action today, Guy?
Welcome back, Courtney. Welcome back. Tim's been away.
Hey.
Thank you.
Welcome back. It's shocking to me. I mean, at one point today, the VIX was 16.5, closed below 14 in an environment where the VIX has no business, in my opinion, being below 14. I explain it the two following ways. I think a lot of it has to do with the beginning of the year inflows in a significant way. That and the fact that the Federal Reserve keeps pumping in liquidity at record paces, now north of $400 billion since September. At this pace, by April of this year, we will have exceeded the all-time high for the balance sheet for the Federal Reserve, which in my mind is just madness. I think that's the explanation. Now, the fact that Facebook continues to rally despite the headlines we've seen, very interesting. We'll show a chart later, but Facebook is now pushing up against levels that it topped out about 18 or so months ago. Look, I've thought this for a while incorrectly, but, you know, I hate to use the term whistling past the graveyard, but in a lot of ways, I think that's exactly what the market did today.
Well, I tell you what, so Happy New Year, everybody. Can we still say that, Guy, by the way?
We can say it now, Tim.
Okay.
But in June, it's not going to fly.
Got it. So look, obviously, as we got into everybody knows the melt-up was a function, I think, of central banks galore, and that on top of a trade truce, whatever we're calling it. The market's going to focus on fundamentals pretty quickly. We've got earnings coming up. We've got Constellation in a couple of days. You've got Bed Bath & Beyond. You've got some retail coming in. So when you look at valuations, there's nothing to get excited about. But when you look at mega cap tech, you can make an argument that valuations at Facebook, which I always usually push back on, but Google's valuation is fine. Amazon's valuations never mattered. And Amazon has now started to break out and was really the one, FANG stock, if we're still using that term in this new year, that actually didn't participate. So I think markets right now are rightly focusing that geopolitics have never been in the short run something that's going to derail the economy. There's no economic impact in what's going on right now, and people are focused on stocks, and it is about allocation.
But Karen, for so long, we were so focused on the U.S. and China, and those were the macro headlines that were really guiding things. So why are these headlines not moving the market so much?
Because I think the China headline is in a positive limbo place for the next 2 weeks, right? We think we'll see at least the first phase, whatever that is. We'll see a deal there. If there were trouble there, then I think we wouldn't see this tape. It's astounding to me that we had one down day, 1 day of oil spike in a pretty big volatile situation. That's amazing to me. I mean, it just speaks to the U.S. independence, being independent of the Middle East. That's amazing to me. But I also think it speaks to the strength, the perceived strength of the U.S. economy, right? Well, if that starts to get a little shaky, which I don't think it will. I mean, we saw that little PMI number last week, but if that's, I think, between earnings, as Tim said, if we have a China deal, if we don't have a massive increase in volatility in the Middle East situation, Guy's point of why we're at a 13.85 VIX, that's amazing to me. It just says the market wants to go higher.
Well, the central bank point is a big one. When you think about that expanded balance sheet over the last 4 months, what's also happened, the dollar has hit a 6-month low. So when you're talking about interest rates that have gone lower, right, and they're just going to stay low, the 10-year could not get above 2%. The Dixie went from 100 back to about 96, 96.5, 6-month low, like I just said. That is obviously supportive of U.S. multinational EPS at a time where we're seeing wage inflation, right? But I got to go back. You mentioned that manufacturing number. That was at a 6-month low. The trade truce, if that's the best that we have right now, if we kind of see input costs going up, like oil, for geopolitical reasons, and we do see a U.S. economy that is firm and we see wages at least stay firm, that's not a great scenario for U.S. corporate earnings, despite that dollar and despite interest rates being lower. So I'm talking out of both sides of my mouth. The point is, we don't know what's going to happen here, right? And it's not a great scenario to have an uncertain trade scenario and then really what seems to be one of the worst geopolitical flare-ups that we've been involved in a very long time. So to me, when you say S&P up 28% last year, low single digits EPS growth, then you look at expectations for 2020 and you're saying high single digits, and you say to yourself, wait, I'm not so certain we can get there. So maybe last year's 28% gain incorporates any and all good news we're going to get over the next few months.
Well, it's a new year, and I'm reluctant to agree with you out of the gates. But it's hard to argue, and the points that I would make are price to sales. We're at 2000 bubble levels. EV to EBITDA, we're at bubble 2000 levels. We've got a market that's so reliant on the consumer right now. We've got numbers this week. I mean, we've got a payroll number. We've got non-farm payroll on Friday. We've got ADP out on Wednesday. And we had a very strong November. So even if you're just talking about how you tactically might play this, I think you set up for a December number, which probably gives something back from November. But the consumer is really what this is all about, and fundamentals are what this is all about. And I think we're finally going to get back to earnings. That's really what I think the litmus test should be about, because there will be no trade truce to talk about. And central banks are doing nothing in the short run. It's getting back to valuations, and that should matter, and that does concern me.
Karen, what do you think the biggest risk for the market is right now, then?
I've got to think that the trade deal falling apart. Okay. That's for months, that's been my biggest fear. And I think that's what the market most reacts to, more than the Fed even.